And with that, I pass over to Dante Disparte, who is the Chief Strategy Officer and Head of Global Public Policy at Circle. And for those who are not aware of it, Circle is one of the providers of stablecoins, so one of the elements or subsets of products covered by MiCA. But Dante can explain a bit more how stablecoins differ from some of the crypto experiences we've seen in the recent months in the markets and the, let's say, volatility of pricing of those crypto assets. Dante, over to you.
Thank you once again to Nicholas Reinhardt and the good folks at Afore Consulting for inviting me to provide some comments today in the 7th annual FinTech and Regulation Conference. I regret not being there in person, but it would only seem fitting that we would leverage technology so that I could magically beam in for today's conversation. In today's presentation, I will talk about the fact that not all money is created equal, and we'll try to reconcile a tale of crypto, money, stablecoins, and central bank digital currencies. A little bit about myself first. I'm Dante Disparte. I'm the Chief Strategy Officer and Head of Global Policy for Circle. Circle is the issuer of USDC, a dollar digital currency at more than 40 billion in circulation, which has powered a Cambrian explosion in open innovations and transmissible forms of digital cash available to users all over the world. Prior to joining Circle, I feel a special obligation along the topic of central bank digital currencies. I was one of the founding executives of the Libra project, which was later rebranded as Diem. And that project, as I think hindsight has told us, win, lose, or draw, it was a world-changing effort. Prior to joining the Libra project, I've spent a career as an entrepreneur at the nexus of technology, resilience, and global security issues. So it's really great once again, and I'm deeply honored to be a part of today's conversation. So the topics we'll cover in today's discussion is to try to provide a guided journey through the future of money and payments and the movement of value on the internet. But we must begin with some anchor concepts. First, what is money? Second, what are central bankers thinking? And what about the boundaries that they typically have when it comes to these novel technologies and payments and financial services? And then finally, we have to ask, I think, a somewhat rhetorical question. Is the advent of competition in new technologies and money and payments completing the financial system or perhaps competing with it? So let's dive in. First, what is money? The classical definition of money is that it meets three criteria. First, it has to be a store of value. The second, a unit of account. And third, a medium of exchange. But yet, one of the ironies is that still today, 50% of the world's population are suffering subject to hyperinflationary domestic currencies. And yet still 60% of the world's transactions are still in cash. And so as we define the future of money and payments, one concept that I think is really critical, at least from my lens, is this notion of payment systems and financial services optionality rather than one innovation substituting the other. Another piece that is, in my mind, a really critical component of understanding money is, of course, understanding our species. And one of the unique attributes that our species has is the ability to ascribe our collective beliefs into amorphous concepts and institutions. For example, the concept of democracy, trust in public institutions, and money itself, in many respects, is one of these distinguishing features of the human species. This, if you want more on these concepts, I highly recommend the writings of the historian Yuval Noah Harari, who has expanded these concepts. There's also some really important philosophical questions that we must ask when it comes to cryptocurrencies. And one of the premises and promises that they were supposed to provide, which is that, is it really your money if you have to pay someone to hold it for you and ask someone for permission to send it? Meanwhile, most of our financial needs do not take bank holidays. And as we learned very painfully through the context of the COVID-19 pandemic, money strictly in analog form or strictly flowing through often closed banking networks that are dominated by brick and mortar has in some respects reached a point of diminishing returns. Lastly, begging an important question, by today's regulatory and compliance standards, would cash be authorized as an innovation given, I think, three key criteria? The first, the lack of transmissibility in an always-on global economy. The second is that cash oftentimes is the currency of choice for illicit activity. And the third, as we saw in the context of the COVID-19 pandemic, it was a vector for spreading disease. and so much so that some countries even resorted to physically laundering their money or begging their populations to put more of it in circulation. And so this idea of competition or completion of unfinished work in the financial system we'll revisit throughout today's discussion. So then there's this really important trend that has begun in earnest with central banks and this notion of digital transformation of central banking and payments. And I ask the question here, to CBDC or not to CBDC? One thing that is critical, of course, is to create a taxonomy for where do CBDCs sit vis-a-vis other forms of payments and other forms of monetary and financial innovations in a free economy. And so one thing that's really important is I think this graph that the Bank for International Settlements has developed, often referred to as the money flower. There's forms of widely accessible money, which is the blue petal, digital money, which is the teal colored petal, central bank issued money, which is the lighter blue petal, and then finally peer-to-peer or token-based money, which is the yellow petal. And perhaps a little conveniently, central bank digital currencies are designed, or at least theoretically designed, to straddle each of these features of widely accessible, digital, central bank issued, and peer-to-peer. And yet today, many of the innovations that are currently circulating, or at least those that appear to be somewhat consistent with rules-based competition in financial services, are issued by regulated entities and oftentimes take the form of peer-to-peer payments innovations or tokenized innovations. Yet today, and many frame this a little bit as a central bank digital currency space race, something like 114 central banks around the world are in various degrees of study, looking at the risks, the merits, and the potential operating model of central bank digital currencies. I must say, however, prior to the announcement of the Libra project, the concept of a central bank digital currency was largely abstract and, amongst many central bankers, not a terribly favorable concept. And so a world being responsive to fears of big tech, entering the movement of money, or fears of potential nation state actors, and China particularly, having forms of money that would be extensible well beyond their borders, has triggered nothing short of a digital currency space race. The question, of course, is like the real space race, what type of destination will political and regulatory leaders provide? And how do we marshal whole of society approaches that can spur responsible innovation while at the same time providing continuity of central bank sovereignty over monetary policy and the movement of money, while at the same time promoting rules-based competition? And this is an important trend. This presentation here is borrowed from The Economist, which looks at the sentiment of central bank speeches towards central bank digital currencies over the years. And as we could see here, prior to 2019, most of the sentiment captured in central bank presentations and discussions about central bank digital currencies skewed negative, begging many questions, as would the central banker violate certain norms around competition, intermediation, the transmission of domestic monetary policy, and in the extreme, does the advent of a central bank digital currency potentially blunt competition amongst the two-tiered banking system, non-bank actors in the financial system, and so on? And so this question in my mind still remains unanswered. And many of the CBDC projects that we see around the world are still weighing not only the public policy pros and cons, but also the potential likelihood that the circulation of central bank digital currencies introduces a potentially lower form, or at least real or perceived, lower form risk asset in an economy that could potentially put downward pressure on the deposit system. One of the reasons we see central bank digital currency projects having balance limits is to guard against that risk, but there's also some other potential limitations that are emerging, such as, for example, in Europe, the idea that the digital euro would not have programmability, and so on. And so there's still a lot of fundamental design questions being asked and answered as central banks weigh these options. And one of the really important pieces of the puzzle is that we have yet to determine an ultimate consensus approach. There isn't yet a one-size-fits-all model. In many cases, central bankers have to weigh the pros and cons and the depth and vibrancy of competition in their financial system and in their banking system. But at the broadest level, whether central banks take a claims-based approach or an account-based model or an object-based model, there's still a long way to go before there's a perfect blueprint that fits the design of central bank digital currencies. Some speak of wholesale central bank digital currencies, retail, general purpose. The future perhaps will be hybrid, but we have yet to see. On this side of the Atlantic in the United States, for example, the Federal Reserve's own Project Hamilton analysis, which was carried out by the Boston Fed, really calls for three criteria to be met with a US central bank digital currency, to the extent, of course, Congress provides that authority to the Fed. And the criteria are intermediated, privacy preserving, and finally, satisfying know your customer requirements. In that model, you would argue that this would be an innovation flowing through the banking system, then begging another critical question, which is, are we designing these as intranets of value in the face of the need around the world for a so-called internet of value that can create general open systems that allow for transmissibility of money and payments around the world? And of course, many of the policy opportunities that central bankers are weighing when it comes to central bank digital currencies include things like faster payments. We saw this laid bare with the advent of the COVID-19 pandemic in an unprecedented mobilization of government to citizen payments around the world to stave off the economic cost of the pandemic and to prop up the most vulnerable in our communities. We also saw many issues in terms of transmissibility of cross-border payments and the exacting cost that the pandemic had on vulnerable communities, for example, diaspora populations sending remittances back home. So as central bankers are weighing the pros and cons, there is this question of the boundaries of which a central bank can, of course, issue a digital rendition of its currency, but still contain some degree of monetary policy where a digital rendition would fundamentally be universally portable and accessible to users around the world. But then there's one really key distinction, is that among many of the central bank efforts that are underway, and of course, a lot of the studies about the pros and cons, is in my mind, there's one key attribute, which has nothing to do with technology, but rather has to do with legal frameworks, which is this notion of digital legal tender status. So cash, in many respects, is the ultimate form of censorship-resistant money. It is the ultimate form of conveyance for all debts, public and private, in most economies around the world. Again, reminding people that, in many countries, cash is often not worth the paper it is printed on, where it is hyperinflationary. The idea of a true retail central bank digital currency is that it would meet all of the criteria of cash, meet all of the three criteria that we described of money at the outset, but also introduce this notion of digital legal tender status. But the question then is, can that same status be conferred to alternative financial instruments in circulation today? For example, legislation here in the United States normalizing the use of so-called payment stablecoins like USDC and many others could potentially confer this notion of digital legal tender status, right? At a minimum, having legal criteria that afford many of the same common features, but protect and support this concept of intermediation. In Europe, for example, the markets and crypto assets framework would have a taxonomy for privately issued digital euros, but would have them conform with electronic money criteria. Perhaps that is a more enduring operating model over the long run, but again, time will tell which operating model prevails. The one other really critical piece of the puzzle is, to understand the future of money and payments, past is prologue. And today, most so-called value-added money in circulation on the planet is responsive to public sector oversight, monetary policy, financial integrity norms, and many other issues. However, it often rides on private sector or consortia rails. And we could name so many household name organizations that fit this criteria, from SWIFT to ACH transfers to fast payment systems, Visa, MasterCard, all forms of ubiquitous financial services that have been value added to the movement of money are oftentimes private sector innovations that are responsive to a host of criteria around innovation, inclusion, and protecting the integrity of the financial system. I think the advent of digital currencies is responsive to those same three trends. One important question, of course, is cash dead? And no one who has had the lights go out or who has had a breakage in their internet connectivity, or in the case of the cryptocurrency community, the question of lost keys equaling the loss of your crypto assets, has ever regretted having physical cash. And so the short answer is no, cash is not dead. If anything, the idea of limitations in cash in some countries, including the United States, there's a small uptick in circulation in cash, whereas in other countries like Sweden, the circulation of cash has, of course, declined. And in many other places around the world, cash is one of the methods of not only preserving optionality, but is the ultimate form of privacy-preserving, censorship-resistant money. But in the 21st century, it is only as transmissible as far as my arm could reach, and therefore it does present many limitations. And so the advent of a form of digital cash tokenized cash that can meet the three criteria of money: unit of measure, store of value, medium of exchange, while at the same time inheriting the transmissibility of the internet, I think is a very, very powerful breakthrough. And we're only now seeing really what that could look like in terms of enhancing a whole host of different criteria. But there are some reasons for concern, and these are not only my own. I think the reasons for concern with this question of central bank digital currencies and the broader societal question of to CBDC or not to CBDC are many of the policy boundaries implied by a form of money widely circulating in a free economy that could potentially introduce some potentially anti-democratic tendencies. For example, a central bank digital currency, as the former US Treasury Secretary Hank Paulson noted, is nothing more than the sum of its parts. And so if you're an authoritarian country, the potential specter of deplatforming people for money, the specter of having the erosion of privacy, and a form of money that can be directed and shut off, for example, could have both bad harm in society as well as some positive impacts. There's also a host of questions about censorship resistance. And this notion of, at the extreme, do retail central bank digital currencies convert central banks, which are typically dealing with macroeconomic issues, inflation targets, quantitative easing, employment targets in an economy, does it fundamentally turn them into a source of competition to their high street banks or their retail banks? There's also a whole host of issues related to technology capture. Indeed, one of the biggest risks posed by central bank digital currencies, again, depending and guarding against which variant enters into circulation, is this notion of technology capture in the banking and payment systems. All too often, public sector investments in technology have to build 100-year bets. And the technology for moving money in the internet age is advancing according to Moore's law. And that's a hard place to be, in my mind, with taxpayer resources. And so I've often analogized the tendency to want to digitize central bank money as analogous to aviation safety authorities both choosing to fly planes and build jet engines, as opposed to designating responsible conduct in the skies. And the last point, of course, is in a world in which central bank digital currencies are widely circulating, the central bank then has to satisfy the three criteria that the US Fed has identified: intermediated, privacy preserving, and satisfying know your customer requirements. This then implies that there's either going to be a centralized honeypot database of personally identifiable information. I would remind everyone, of course, of the honeypot database of the Equifax breach here in the United States, but it also poses a whole host of other long-range risks. And so we will see how this bears out. And of course, the findings of these 114 central banks that are reviewing the merits and the risks of central bank digital currencies will tell us a lot of that direction of travel. I should also say in most countries around the world, oftentimes the central banks do not yet have political or regulatory authorities to carry on with this work. So for example, last year in the United Kingdom, there was a parliamentary inquiry that found that perhaps these were innovations or solutions looking for problems. I think a similar process is afoot here in the United States, as all the central bank digital currency efforts being carried out by the Fed require congressional authorities that are still under review. And equally, I think in Europe and other jurisdictions, the politics of digital money coming from the public sector is still yet to be reconciled. But there are, I think, important innovations to be had. And although the content on this slide might be a little small, I do think when it comes to money, and especially when it comes to money in the internet age, there are a host of different criteria that need to be weighed in the design and in the potential pros and cons of digital money, whether central bank issued or privately issued. And here are a few of them: scalability, the provision of extra services, for example, composability and programmability are key features that we often talk about in the digital currency arena. What happens with interest returns, if any, and how do they pass through, if at all, without becoming securities along the way? The broader question, of course, is it's not enough to digitize money. You also have to build merchant acceptance and acceptance networks around the world. For example, in the case of USDC, the Visa network has made it a settlement option for more than 70 million merchants around the world, and that thus creates this economic flywheel. There's also really critical questions here about settlement finality. And one of the potential challenges with blockchain-based financial services and payments is that once a transaction is made, it is final. And oftentimes that the ability to revoke a transaction is as good as your ability to reach the counterparty that you paid. Of course, ease of use and ease of loss, the not your keys, not your crypto analogy, I think holds true here, but there's also a whole host of attendant risks with novel technologies or novel innovations. I'm a big believer in the concept of complex systems fail in complex ways. And so we have to weigh that all the time as we weigh both public and private innovations in this space. There's clearly a default risk inherent in any form of digital currency. We learned in 2022, for example, that not all stablecoins were created equal. Many were stable in name only, and there's still big questions to be asked about the bank-like risk inherent in the digital assets arena. But I think that same specter holds true in the public sector. And while notionally central bank digital currency would be an infinite liability of the public sector, again, most countries around the world and 50% of the world's population are subject to domestic hyperinflationary currencies or are at the mercy of international hard currencies as a source of balance of payments and sort of foreign receipts. Lastly, there are really critical questions about the sources of friction. An intranet of value, which in my mind is what often is the real design architecture of central bank digital currencies, might be a form of competition with domestic fast payment systems or real-time gross settlement systems, or candidly, another policy opportunity merely to create open banking networks and to eliminate some of the insidious death by 1,000 cut fees that subjects both users, businesses, and people to high costs for basic services and payments. However, this idea of a frictionless, high trust, user-directed payments environment really does necessitate open architecture, or what I like to classify as an internet of value, as opposed to an intranet or an extranet. And then the last question, of course, is for any form of digital cash to really meet that criteria of censorship resistance and the preservation of privacy, it has to have some degree of anonymity around it. And that, of course, on the one hand, presents tensions with privacy regulations such as the GDPR in Europe, but it also creates a tension around this expectation in regulated financial services that you know your counterparty. And candidly, one of the biggest tensions in crypto and digital assets altogether has very little to do with bank-like risks and more to do with payment systems risks and financial integrity risks, particularly because of the pseudonymity or the anonymity of many of the digital wallets that are connected to this so-called internet of value that is emerging. Then there are, of course, this question of geopolitics and geoeconomics, and do digital currencies introduce, for example, as was the case with the Libra project, the specter of globally systemic networks and global systemic stablecoin arrangements? Do these then also introduce this notion of dollar hegemony and advance, the soft power implied by digital dollarization being a form of dollarization that runs alongside traditional banking and payment systems? There's also a whole host of questions, I think, inherent in any form of digital currency and digital asset, which is, are these innovations that can help circumvent rules, sanctions compliance, and tax obligations, or are they potentially additive? Then there's this really real long-term set of perceived and real linkages that the advent of digital currencies equates to an increase in ransomware attacks and cybercrime. Whereas in my world, I would argue that oftentimes the biggest risk in any type of cyber vulnerability sits between the keyboard and the chair. And the digital thrift used to settle an account has less to do with the fundamental vulnerabilities we have societally. There's a whole host of other concerns. The Financial Stability Board, the Bank for International Settlements, many, many global bodies have been preoccupied since 2019 and before about the potential rise of systemic risk, prudential risks, and other risks to the global financial system. And yet, despite those observations and many reports, I still find that we're in a hurry up and wait operating model when it comes to the advent of responsible regulations that bring these innovations on shore and start to live by the standard of same risk, same rules, technology neutral regulation to the sector. There's, of course, I think, a more fundamental set of issues at play here, which have very little to do with the bank-like risks and the quality of digital assets, and more to do with the potential weaponization of currencies, payment systems, and financial market infrastructure. Indeed, as the specter of war has returned to Europe in Russia's war of aggression against Ukraine, the effectiveness of non-violent sanctions and economic sanctions against Russia is really the extent to which payment systems such as SWIFT and others are responsive to sanctions. And that requirement, I think, is really critical. You could argue that much of the work taking place amongst some potentially hostile nations with central bank digital currencies and payment systems is to have a form of moving money and value that can be exported as a part of trade and bartering, but can create parallel money movement networks that are non-responsive to Western sanction regimes and non-responsive, as we saw in the case of Russia, to some of these financial obligations and norms in the rules-based global economy. Indeed, ever since the now more than 20 years since the post 9/11 global financial crime compliance framework was not only instituted, but promulgated from the United States around the world, we have not yet had material updates in fundamental things like know your customer requirements being a precondition to entering the formal economy. Not of course, asking the inverse question, which is that there's always a risk in doing something and innovating and introducing new technologies to the global economy. But in my mind, there's also a risk in doing nothing. And that keeping entire continents due to bank de-risking and regions of the world due to that same de-risking phenomenon or the cost of serving people is itself a source of great risk, giving rise to illicit activity, anti-money laundering risk, terrorist financing risk, and many others. And so this notion of global digital cash connected, where any basic internet connected device can be a part of a global compliant payment endpoint, I think is a really critical addition. There's a whole host of Orwellian issues that can arise around the erosion of privacy in financial services. I think we already suffer from that vis-a-vis the utility and the dependency on things like credit bureaus like Equifax, TransUnion, and Experian as three recent examples. Those are all preconditions of getting access to the formal economy, but we should ask ourselves some really critical questions about the boundaries of privacy and financial inclusion, if to be included financially as a public good in the first place. And lastly, 3 billion people and counting, and many more still at the mercy of very expensive financial services. We need to introduce some optionality and challenges to the way money has moved historically, whether central bank digital currency, privately issued digital currency, or others. These are, in my mind, very critical innovations to fulfill a lot of unfinished work. So then that transitions over to the question, are we in fact deadlocked in a competition where it's central bank digital currencies versus privately issued stablecoins and others, or are these innovations completing unfinished work in the traditional economy? So the future of money and payments and the quest towards this internet of value, open, universally accessible digital currencies that can at the same time preserve privacy and are compliant and afford over time this concept of digital legal tender status, in my mind, is the biggest breakthrough that we can spur. And I think it is deeply in the transatlantic interest to figure out how to normalize those standards for onshore rules-based competition in the movement of money. And so emblazoned on the physical US dollar, you would find the words "in God we trust," hearkening back to the concept I opened up at the outset, which is that our species can ascribe concepts to these, collective concepts to amorphous things: trust in money, trust in democracy, trust in institutions. But to the 200 million plus end users of digital currencies and digital assets, arguably, and candidly, this may very well be a generational reality, they care about the concept of "in code we trust" and have opted in to a form of political economy that is user-centric, device-centric, and always on, very much like the internet habits of younger generations. And so at Circle, our experience over the 5 years of USDC entering circulation and the 10 years of operating the company is that the two concepts are not trade-offs, and that you can in fact have responsible innovations in global financial services and digital currencies that advance financial inclusion norms, but at the same time can be exponentially better off vis-a-vis financial integrity conditions. Critically, I think it's also important to acknowledge that unlike a lot of the concerns from traditional banks that the advent of central bank digital currencies would erode their deposit base, the existence of USDC, which is today dollars held in the care, custody, and control of US regulated financial systems, dollars and US treasuries, is that we are not putting pressure on that downward pressure on that deposit base, but rather working in lockstep with a wholesale set of banking partners that stand behind us. And so that model of all ships rising in regulated financial services, I think has not only withstood great stress tests in 2022 and beyond, but has demonstrated this kind of open, connected internet of value can be additive to banking and payments as opposed to disruptive to them. There's also this question of advancing financial integrity norms. So a company like Circle today is licensed comprehensively in the United States, equivalent to major payments institutions like PayPal and Stripe and others. But at the same time, we're also helping normalize financial integrity norms federally by reporting SARS filings into FinCEN and by trying to give bad actors few places to hide, whether domestic or abroad. There's also a really critical set of notions here around the use of open technology. Last year, I think one of the bigger technological breakthroughs was the Ethereum merge, the transition from a proof of work to a proof of stake validation algorithm was a big deal. In our view, perhaps akin to the fusion breakthrough we saw with energy in California at one of the national laboratories. And that idea of constantly upgradable open financial markets infrastructure is a pathway for creating a more open financial system, spurring responsible innovation, and ensuring that you don't have this risk of technological obsolescence or single source of failure cyber vulnerabilities, as we saw with Equifax and many other risks since. But that test requires of regulators and policymakers a genuine commitment to this idea of same risk, same rules, technology neutral regulation. Lastly, I think a lot of these innovations today have already demonstrated adherence to many of the norms central bankers are talking about when we describe the idea of an intermediated financial system, one that preserves privacy, one that is rules-based, and lastly, one that can conform with know your customer and other financial integrity norms. In many cases, the way Circle is operating very much reflects this vision of a wholesale financial markets infrastructure that is promoting responsible dollar settlement on the internet. That's not disruptive to the traditional financial system, but it's very much fulfilling things that could not be done if the financial rails were closed, and overcoming what is known as the walled garden phenomenon in banking and payments. Last but not least, I think it's really critical amongst many jurisdictions around the world to invite the time, talent, and treasure of responsible actors, developers, and companies, which not only promotes economic competitiveness, prosperity, and global security, it allows for those jurisdictions to bring on shore operators that care about consumer protection, market conduct, financial integrity, and the rules-based financial system. Therein, in my view, lies the real critical opportunity of building a more future-proof version of the financial system. So with that, I want to share a few more resources that are available. I have a lot of writing on the topic of responsible innovations in financial services, technology, central bank digital currencies, and their ilk. And I'm very grateful once again to Afore Consulting, Nicholas Reinhardt, and the organizers for the opportunity to share a few words with you today. Thank you so much.
Thank you very much indeed, Dante. And it will not come as a surprise to you. We had quite a few requests come in to share the slides. Watch our website over the next few days. You should be able to have access to the information.